Before we jump in, please remember that I am not a licensed financial advisor or insurance agent. This video is for educational purposes only, designed to help you understand the landscape of the insurance industry. Always consult with a qualified and licensed professional to discuss your specific, individual needs before making any insurance or financial decisions. You get into a fender bender. It's not your fault. The other driver ran a stop sign. Annoying, but that's why you pay hundreds of dollars every month for car insurance, right? So you call the 1-800 number on your insurance card, the company with the funny commercials you've been with for 6 years. You navigate an endless phone tree, finally get a human, and spend 45 minutes explaining what happened, only to be transferred to a different department where you have to explain it all over again. A week later, you get a lowball offer for repairs, and a month after that, you get a letter in the mail. Your rates are going up. If that scenario makes your blood boil, you're not alone. And what if I told you the real problem wasn't the accident? The real problem was a decision you made years ago, a decision you probably spent less than an hour on, choosing the type of insurance company you did business with. The single biggest mistake millions of Americans make with their car insurance has nothing to do with their deductible or their coverage limits. It's that they don't understand that not all insurance companies are built the same. They operate on fundamentally different business models, and that difference determines everything: the price you pay, the service you get, and most importantly, who they really work for when you file a claim. Most people shop for car insurance completely backward. They go online, punch in their info, and see a list of names: Progressive, Geico, State Farm, Allstate, maybe a local name they've never heard of. They pick the cheapest one. Job done. But that's like saying you're going out for dinner and just picking the cheapest restaurant without knowing if it's a fast food joint, a family diner, or a 5-star steakhouse. The food might fill you up, but the experience, the quality, and what happens if you get food poisoning will be drastically different. In this video, we're going to fix that. We are pulling back the curtain on the entire U.S. auto insurance industry. I'm going to arm you with the knowledge that separates a savvy consumer from an easy target. We will break down the 3 primary types of insurance companies you can buy from. Not the brands, but the models, the direct writers, the captive agents, and the independent agents. By the end of this, you will understand the hidden DNA of each model. You'll know their strengths, their weaknesses, and the secret trade-offs you're making that aren't mentioned in their billion-dollar advertising campaigns. This knowledge will not only save you from headaches and frustration, but could literally save you thousands, even tens of thousands of dollars, by ensuring you have the right protection from the right partner when you need it most. So let's get into it. Let's start with the giants, the titans of television advertising, the companies that have spent billions to become household names. Let's talk about the first type, the direct writers. Who are the direct writers? Think Geico, Progressive, Liberty Mutual, Insurance. The defining characteristic is right there in the name. You, the customer, deal directly with the company. There is no middleman. There's no local agent with their name on a shingle down the street. Your entire relationship is with the corporation itself, conducted through a website, a mobile app, or a massive call center. Now, the appeal of this model is powerful and brilliantly marketed. It's all about speed, convenience, and most importantly, the perception of a lower price. Their pitch is simple. We cut out the agent and we pass the savings on to you. And for a straightforward, simple policy, they can sometimes offer very competitive rates. Their overhead is lower. They don't have to pay commissions to a vast network of agents or fund thousands of brick-and-mortar offices. Instead, they pour that money into technology and advertising. Their websites are slick. Their apps are user-friendly. You can get a quote in 15 minutes and be insured without ever having to speak to another human being. In our on-demand Amazon Prime world, that is an incredibly seductive offer. You are in complete control. You are the one making the choices, clicking the buttons, and buying the policy. But here is the critical trade-off, the part that gets buried in the fine print. When you're in control of everything, you are also responsible for everything. The person you might talk to on their 1-800 number is a call center employee. They may be perfectly nice and well-intentioned, but their job is not to be your personal risk advisor. Their job is to process your request as efficiently as possible according to their script and move on to the next call in the queue. They work for the insurance company, and their primary loyalty is to their employer's bottom line, not to your financial well-being. They are not incentivized to ask the deep, probing questions that uncover potential gaps in your coverage. They are trained to sell you their company's products, and only their company's products. They can't tell you that their motorcycle insurance is overpriced, or that their homeowner's policy has a nasty water backup exclusion that a competitor doesn't. They can only offer you what's on their menu. You don't know what you don't know, and frankly, it's not their job to educate you beyond the basics. Let's make this real. Imagine you and your spouse have decent cars and a clean driving record. You're a perfect customer for a direct writer. You save $30 a month. Feels great. Then life happens. You have a teenage son who just got his driver's license. You add him to your policy. What you don't know is that your direct writers rates for teen drivers are astronomically high compared to the rest of the market. But you don't know that because you only have one company to look at. You're now overpaying by $1,200 a year. Or worse, consider a claims scenario. You have that fender bender. With a direct writer, you are on your own. You are one person, armed with your policy document, going up against a multi-billion-dollar corporation with an army of claims adjusters and lawyers. The adjuster you deal with is an employee of the company. Their job, at its core, is to minimize the company's financial payout. They are trained negotiators. You are not. There is no one in your corner, no advocate who knows you and your family, to make a call on your behalf and say, "Hey, the Smiths have been loyal clients for a decade. Let's make sure we take care of them here." You are just a claim number in a system designed for maximum efficiency and minimum payout. So, the direct writer model is built for the simple, the straightforward, and the self-sufficient. It's for the person who has a single car, a perfect record, no complex assets to protect, and who is comfortable doing all the research and taking on all the risk of being their own expert. It offers speed and a digital-first experience, but it comes at the potential cost of personalized advice, expert guidance, and having a true advocate on your side when things go wrong. You are the pilot, the navigator, and the mechanic. If you're comfortable with that, it can work. But what if you're not? What if your life is a little more complicated? What if you want a co-pilot? Someone who is an expert on a specific set of tools and can guide you through the process? That brings us to the second major type of insurance company, a model that has been the bedrock of the industry for over a century: the captive agent. This is the world of the independent insurance agent. Think of it this way. If you want a specific brand of soda, say Coca-Cola, you can go straight to a Coca-Cola vending machine. You put your money in, you get a Coke. It's fast, it's direct, it's efficient. That's like a direct writer. Now what if you go to a local State Farm or Allstate office? That's like walking into a Coca-Cola brand store. They are experts on everything Coke, classic, diet, zero sugar, and they can sell you any of them. But they can't and won't sell you a Pepsi. They are captive to one brand. The independent agent is the supermarket. When you walk into a supermarket, you see an entire aisle of choices. Coca-Cola is there, but so is Pepsi, Dr. Pepper, 7-Up, and a dozen craft sodas you've never even heard of. The person stocking the shelves doesn't care which one you buy. Their job is to help you find the drink that's right for your tastes, your budget, and your party. That's the independent agent. They aren't employed by Travelers or Progressive or the Hartford. They are independent business owners who have contracts or appointments with multiple insurance companies. Their loyalty isn't to a single carrier. It's to you, the customer. They are your personal shopper in the complex and often confusing supermarket of insurance. This model is built on a foundation of choice and advice. The agent's primary role is to get to know you. They'll ask about your car, sure, but they'll also ask about your commute, the young driver who just got their permit, the home you own, the small business you run from your garage. They're building a complete picture of your life's risks. Then, they take that information and go to work, shopping their network of insurance carriers to find the best fit. They might come back and say, "Okay, Carrier A has the absolute lowest price for your auto policy. But if we bundle your home and auto with Carrier B, the overall cost is lower, and you get much better liability protection on your house. Plus, Carrier C has a fantastic forgiveness program for your teenage driver's first accident." You're not just getting a quote, you're getting a strategy. The companies that operate in this space are some of the biggest and oldest names in the business. You've probably heard of many of them, like Travelers, the Hartford, or Safeco, which is actually a part of Liberty Mutual. And here's where it can get interesting: some companies play in both worlds. You see ads for Progressive everywhere, and you can go to their website and buy a policy directly. But Progressive also has a massive network of independent agents who can sell you that exact same policy, often while also quoting you on several other carriers to make sure the Progressive price is truly competitive. They're hedging their bets, reaching customers who want to click and buy, and customers who want to sit down and talk. So what are the real, tangible benefits of going this route? The first and most obvious is comparison shopping done for you. Instead of you spending hours filling out 10 different online forms, getting 10 different quotes, and trying to compare apples to apples when the coverages are all slightly different. One agent does all that legwork. They know the ins and outs of each company's policies and can translate the fine print into plain English. The second major advantage is expertise. A good independent agent lives and breathes insurance. They understand that the state minimum liability coverage is almost never enough to protect your assets in a serious accident. They know which companies have the best claim service in your specific region. They can advise you on whether an umbrella policy makes sense for your financial situation. This is professional advice that a website's algorithm simply cannot replicate. You're not just buying a product, you're gaining a risk advisor. But perhaps the most powerful and overlooked benefit comes when things go wrong. Let's say you get into an accident. It's a stressful, chaotic time. If you bought your policy directly online, you're calling an 800 number and talking to a different call center representative every time. You are one of millions of customers. If you have an independent agent, you have a personal advocate. You call them first. They walk you through the process, tell you what to expect, and can go to bat for you with the insurance company's claims department. They have a relationship with the carrier, and they are fighting for their client, you, to ensure the claim is handled fairly and promptly. That single point of contact, that advocate in your corner, can be priceless during one of life's worst moments. Of course, this model isn't perfect for everyone. There are downsides to consider. For one, it might not always be the absolute cheapest option. The insurance carriers that use agents have to pay them a commission, and that cost is baked into the price of the policy. Sometimes the lean, low-overhead model of a direct writer can simply offer a lower price, especially for someone with a simple, straightforward insurance need and a perfect driving record. You're often paying a small premium for the advice and service the agent provides. The other major variable is the agent themselves. The quality of your experience is entirely dependent on the quality of the person you choose to work with. A fantastic, proactive, and knowledgeable agent can save you thousands of dollars and immense headaches over your lifetime. A lazy, unresponsive, or inexperienced agent, on the other hand, can provide a worse experience than just doing it yourself. You're placing your trust in an individual, and finding the right one requires a bit of research, maybe checking local reviews or getting a referral from a friend. Finally, for the tech-savvy individual who loves managing everything through a slick, modern app, the independent agent model can sometimes feel a bit old-fashioned. While many agencies have adopted modern technology, the process often involves more phone calls and emails than the seamless, fully digital experience offered by the big direct-to-consumer brands. You're dealing with a local business, not a massive tech company, and the experience reflects that. So, who is the ideal customer for an independent agent? It's someone who sees insurance not as a commodity, but as a crucial part of their financial protection. It's someone with a life that's a little more complex. Maybe you have multiple vehicles, a young driver, a home, a rental property, or a less-than-perfect driving history. It's for the person who values having a long-term relationship with a professional they can call for advice. If you hear terms like uninsured motorist coverage or liability limits, and your eyes glaze over, an agent who can explain what it all means and why it matters is exactly what you need. It's the difference between self-service and full service. One lets you grab what you want and go, while the other provides a guide to help you navigate the options and make the most informed choice possible. But these two models, the direct-to-consumer giants and the agent-based carriers, still don't cover the entire landscape. There's a third type of insurer that operates on a completely different philosophy. They aren't trying to sell to everyone. In fact, they're exclusive. They are built to serve a very specific slice of the population, a tribe, a community. Membership has its privileges, and in this case, those privileges can include some of the best service and rates in the entire industry, if you can get in. So let's talk about the undisputed king of this exclusive kingdom, USAA. If you've ever had a friend or family member in the military, you've heard the name spoken with a certain reverence. It's not just an insurance company. For many, it's a birthright, a part of their military identity. USAA stands for the United Services Automobile Association, and its origin story is the perfect illustration of why these companies exist in the first place. Picture it. 1922. A group of 25 U.S. Army officers are stationed in San Antonio, Texas. They have a problem, a big one. They're considered a high-risk group by a skeptical insurance industry. Why? Because they move around all the time. To an underwriter sitting in a comfortable office in Hartford, Connecticut, a military officer was a transient, an unstable risk. So they were either denied auto insurance outright or quoted astronomically high premiums. These officers, the very people tasked with defending the nation, were being treated like financial pariahs. So what did they do? They did what highly trained, resourceful people do when faced with a problem. They solved it themselves. They decided to insure each other. They pooled their own money, created their own association, and based it on a simple, powerful idea. An officer is a person of integrity and responsibility. A brother officer, as they called each other, was a good risk. They knew each other's character. They trusted each other. And with that, USAA was born. This origin story isn't just a nice piece of trivia. It is the entire business model in a nutshell. These membership or affinity-based insurers operate on a principle called a favorable risk pool. Think of it this way. A standard insurance company has to insure the general public. That includes everyone. The 16-year-old who just got his license and thinks every street is a drag strip, the person with 3 DUIs, the careful suburban parent, and the retired grandmother who only drives to the grocery store once a week. To make a profit, the company has to charge rates that account for the absolute worst drivers in that pool. The careful drivers essentially end up subsidizing the reckless ones. Now look at an exclusive group like USAA. Historically, their pool was military officers. Today, it's expanded to all ranks of active duty military, veterans, and their immediate families. But the principle is the same. The company is betting that, on average, a person with the discipline and responsibility to serve in the United States Armed Forces is a better, safer, more reliable risk than a random person pulled from the general population. They're betting that this group will have fewer accidents, be more likely to pay their bills on time, and be more honest in their claims. And for the most part, that bet has paid off spectacularly. By carefully curating who they allow in the door, they dramatically lower their overall risk. When your risk is lower, you have fewer claims to pay out. When you have fewer claims to pay out, you don't need to charge as much in premiums. It's a virtuous cycle. The savings are then passed back to the members in the form of lower rates, better coverage, and in some cases, even annual dividends or distributions. It's not just a transaction. It feels like you're part of a cooperative, a club where everyone benefits from the group's good behavior. The primary benefit, the one you'll hear about most often, is legendary customer service. This isn't an accident. The customer service representatives at a company like USAA or Navy Federal Credit Union, which also offers insurance through a partnership, are trained to understand the specific, unique challenges of their members. They know what a PCS or permanent change of station is. They understand the financial complexities of deployment. They won't be confused when you call from an APO address overseas. This shared language and understanding creates a level of empathy and efficiency that is almost impossible for a general insurer to replicate. You're not just customer number 8675309. You're Sergeant Smith, and they know what that means. This builds a bond of loyalty so strong that many families stay with USAA for generations. A child might get their first auto policy with USAA because their parent, a veteran, was a member, and that tradition continues down the line. The second major benefit is, of course, the price. While it's not a universal guarantee that they will always be the cheapest for every single person in every situation, they are consistently among the most competitively priced insurers in the nation. They're lower overhead, they don't have local agents to pay, and they spend far less on advertising than the big national brands because their members are their best advertisement. Combined with that favorable risk pool, creates a powerful financial advantage. But this model isn't just limited to the military. While USAA is the largest and most well-known example, the concept of affinity insurance exists for other groups too. You might find special programs or even dedicated small insurance companies for educators, firefighters, engineers, or members of certain alumni associations. The logic is identical. Gather a group of people who, by virtue of their profession or affiliation, are likely to be a better-than-average risk. A group of accountants is probably less likely to get into a high-speed chase than the general public. A group of university professors might, on average, drive more cautiously. These are all statistical bets that can pay off for both the insurer and the insured. Now for the downside, and it's a big one. It's the velvet rope, the members only sign on the door. The single biggest disadvantage of this model is its exclusivity. If you don't meet the strict eligibility criteria, you simply cannot get in. It doesn't matter how great of a driver you are. It doesn't matter if you have a perfect credit score and a spotless record. If you or your immediate family member never served in the military, you cannot become a USAA member. Period. And that can be incredibly frustrating for consumers who hear about the amazing service and low rates from their friends, only to find out they're locked out of the club. Furthermore, even if you are eligible, it's a mistake to assume they will automatically be your cheapest option. Life is complex. Maybe you have a unique vehicle, a spotty driving record from your youth, or live in a very high-cost zip code. In some specific scenarios, a traditional insurer who is hungry for business in your demographic might actually offer you a better deal. The loyalty these companies command is so strong that sometimes members don't shop around, assuming they already have the best deal, which may not always be the case. Complacency can be expensive, no matter who your insurer is. So this model represents a fascinating corner of the insurance world. It's a trade-off. In exchange for limiting their market to a select few, these companies can offer a level of service and value that is incredibly difficult for mass-market unease to match. They replace massive advertising budgets with word-of-mouth trust and replace transactional customer service with a relationship built on shared identity and experience. They've proven that sometimes the most successful strategy is not to try and be everything to everyone, but to be everything to someone. We've seen the insiders, the exclusive clubs built on trust and shared backgrounds. But what about the vast majority of people who are on the outside looking in? They need insurance too. And among them are drivers that even the big, standard companies are hesitant to cover. This leads us to a completely different type of insurer, one that operates on the opposite end of the spectrum. They don't have a velvet rope. They have an open door, and they specialize in taking on the risks that almost everyone else rejects. They are the non-standard carriers, and their world is governed by a very different set of rules. This is the insurance world's emergency room. It's the place you go when you have nowhere else to turn. For a non-standard carrier, a driver isn't just a collection of data points on a risk profile. They're a story, and usually it's a complicated one. Maybe it's a story involving a DUI or a series of at-fault accidents. Perhaps it's a story of a young driver with a souped-up sports car that makes other insurers break out in a cold sweat. Or maybe it's the simple, common story of letting your insurance lapse for a few months, a decision that suddenly makes you look like an unreliable gamble to mainstream companies. Think about it from a standard insurer's perspective. Their entire business model is built on predictability. They use massive data sets to predict the likelihood of you filing a claim. A clean driving record, a sensible car, a good credit score, these are all green flags. They signal stability and predictability. But a DUI? That's not a green flag. It's a giant flashing red siren. It throws all their predictive models into chaos. An at-fault accident is a data point. A pattern of them is a narrative of risk they don't want to be a part of. A lapse in coverage suggests financial instability or a lack of responsibility, both of which are red flags for an industry built on timely payments and responsible behavior. So when these red flags pop up, the automated underwriting systems at the big-name companies often just say no. The application is denied. The phone call ends with a polite, "We are unable to offer you a policy at this time." For the driver, this can be a terrifying, isolating experience. You need a car to get to work, to take your kids to school, to live your life. And in most states, you legally cannot drive that car without insurance. You're trapped. This is where the non-standard carrier steps in. They don't see a red flag and run. They see a business opportunity. Their entire model is engineered to price high-risk scenarios that standard companies won't even touch. They are masters of the complicated story. One of the most common gateways into the non-standard market is something called In-State Route 22. You've probably heard the term, but it's widely misunderstood. In-State Route 22 is not actually a type of insurance. It's a certificate, a form that an insurance company files with the state on your behalf. This form is your insurer's guarantee to the DMV that you are carrying at least the state-mandated minimum liability coverage. It's essentially the insurance company vouching for you. Who needs In-State Route 22? Typically, it's court-ordered for drivers convicted of major offenses. A DUI or DWI, reckless driving, driving without insurance, or having your license suspended. The court basically says, "We don't trust you to remain insured on your own, so we are requiring proof." The problem is, most standard and preferred carriers won't file In-State Route 22. The moment you mention those 4 letters, their answer is no. They don't want the liability or the administrative hassle associated with a high-risk driver who is being monitored by the state. Non-standard carriers, on the other hand, have built entire departments around handling SR22s. It's a core part of their business. Companies like The General, Safe Auto, and Dairyland are household names in this space. Their advertising is direct and to the point. They aren't selling a dream of bundling your home and auto for a multi-policy discount. They are selling a solution to an immediate pressing problem. Need insurance now? Been turned down? We can help. But this help comes at a cost. A very significant cost. The premiums in the non-standard market are, without question, the highest you will find. This isn't price gouging. It's a cold, hard calculation of risk. The data shows that a driver with a recent DUI is exponentially more likely to be involved in another accident than a driver with a clean record. The insurer has to charge a premium that reflects that massively elevated risk. If they didn't, a single bad year of claims from their high-risk pool would put them out of business. Beyond the price, the product itself is often different. While a preferred carrier might be trying to sell you a comprehensive package with accident forgiveness, disappearing deductibles, and roadside assistance, a non-standard policy is often stripped down to the bare essentials. The primary goal is to get you the state minimum liability coverage you need to be legal. Anything beyond that, like collision or comprehensive coverage to protect your own car, will be extremely expensive, if it's offered at all. The policies are less flexible, the grace periods for payments might be shorter, and the customer service experience, while functional, might lack the polish of a top-tier carrier. It's a bit like the difference between a prime mortgage and a subprime loan. One is for people with stellar credit who get the best rates and terms. The other is for people who are rebuilding, providing a necessary path to ownership, but with much higher interest rates and stricter conditions. Non-standard insurance is that subprime loan. It's not ideal, it's not cheap, but it's a tool. It's a lifeline. Let's imagine a driver, we'll call him Mike. Mike is 25. He had a great policy with a big-name standard carrier. Then, he made a terrible mistake and got a DUI. His insurer dropped him immediately upon conviction. The court ordered him to file in State Route 22 to get his license back. He started calling around. Every company he used to see on TV told him no. He was facing the loss of his job because he couldn't drive to the work site. The panic set in. Then he saw a commercial for a non-standard carrier. He called, expecting another rejection. But the agent on the phone was different. They didn't judge him. They just asked for the facts of the case. They understood what in State Route 22 was and had a process for it. Within an hour, Mike had a policy. The premium was 3 times what he used to pay, and it only covered the bare minimum liability, but it was a policy. They filed the State Route 22 with the state electronically. A few days later, his license was reinstated. He could drive legally again. He could keep his job. For Mike, that expensive bare-bones policy wasn't a burden. It was his salvation. This is the critical role non-standard carriers play in the ecosystem. They provide a safety net, ensuring that drivers who have made mistakes can still meet their legal and financial responsibilities, protecting the other drivers on the road from uninsured motorists. But here is the most important part of the story, the part that offers hope. A non-standard policy is not a life sentence. It is a temporary station, a stepping stone on the path back to a better rate. The journey out of the non-standard market is paved with 2 things: time and consistency. First, you must maintain continuous coverage. No matter what, letting your non-standard policy lapse is the worst mistake you can make, as it just resets the clock on proving you're a responsible risk. Second, you have to drive like your financial future depends on it, because it does. Every single day you go without a ticket or an accident, you are rewriting your story. You are creating a new data set that shows you are a safe, reliable driver. Major violations like a DUI typically stay on your insurance record for 3 to 5 years, sometimes longer depending on the state and the severity. After that period of clean driving, the doors to the standard market will begin to creak open again. You can start shopping around. You might not get into the ultra-preferred tier right away, but you can almost certainly find a standard carrier that will offer you a far better rate and a more robust policy than what you have. The non-standard carriers know this. They know their best customers will eventually leave them. Their business model accounts for this churn. They serve their purpose as a bridge, getting drivers from a point of crisis back to a point of stability. They are the specialists who handle the cases no one else will, ensuring the system keeps moving and that everyone, regardless of their past, has a pathway to get back on the road. They aren't glamorous, but they are absolutely essential. So we've seen the 2 poles of this world: the preferred carriers who court the safest drivers with the best rates, and the non-standard carriers who provide a crucial, if costly, service to the highest-risk drivers. But what about the massive ocean of people in between? The average drivers? The ones with a speeding ticket or a minor fender bender on their record? And what about the very structure of the companies themselves? So far, we've mostly talked about stock companies owned by shareholders. But there's another, older model, a type of insurance company that is owned by the policyholders themselves. They don't answer to Wall Street, they answer to you. These are the mutual insurance companies, and their philosophy changes the entire game. Imagine a company where the customers are the owners. It's a simple idea, but it's profoundly different from almost every other business you interact with. In a stock insurance company, your premium is revenue, your claim is an expense, and the ultimate goal is to maximize the difference between the two for the benefit of a third party, the shareholder. With a mutual insurance company, that third party is removed from the equation. You, the policyholder, are the owner. Your interests and the company's interests are, at least in theory, perfectly aligned. Think of it like the difference between a massive, publicly traded supermarket chain and a local food co-op. At the supermarket, you buy your groceries and the profit goes to investors across the country, or even the world. At the food co-op, you buy your groceries and you might get a dividend at the end of the year. The profits are used to improve the store, lower prices for members, or are given back to the members who shop there. The co-op exists to serve its members, not to generate returns for Wall Street. Mutual insurance companies operate on that exact same principle. When you pay your premium to a mutual company, you are essentially buying a small fractional ownership stake in the enterprise. So what does this mean for you in practical terms? How does this ownership actually translate into benefits? Primarily happens in three ways. First, and most famously, is the potential for dividends. Now let's be very clear. These are not guaranteed. They are not a promise. But when a mutual company has a good year, meaning they took in more in premiums than they paid out in claims and operating expenses, they have a surplus. A stock company would call this profit and distribute it to its shareholders. A mutual company, having no external shareholders, can choose to return a portion of that surplus directly to its policyholder owners in the form of a dividend. It's like getting a rebate on your insurance. Imagine opening your mail and finding a check from your car insurance company, not because you overpaid, but because the company you co-own had a successful year. This is a powerful incentive and a tangible reward for the collective good performance of all the company's members. The second, and perhaps more impactful way you benefit, is through lower premiums over the long term. A mutual company isn't under the same relentless quarterly pressure to maximize profits. Their time horizon is longer. So instead of returning all of the surplus as dividends, they can use that money to fortify their financial position. They can build up their reserves, which allows them to weather financial storms or years with unusually high claims, like a season of major hurricanes or wildfires, without having to immediately jack up rates for everyone. More importantly, they can use that surplus to intentionally suppress future rate increases. Their goal isn't to charge the absolute maximum the market will bear. Their goal is to charge a fair premium that covers expected losses and expenses, and to keep that premium as stable and affordable as possible for their members over many years. This creates a fundamentally different pricing philosophy. They're not trying to extract value from you. They're trying to provide value to you. The third benefit is a focus on service and stability. Since they don't have to siphon off profits for investors, more of your premium dollar can be reinvested back into the company itself. This can mean investing in better technology for a smoother claims process. It can mean hiring and training higher quality customer service representatives who are empowered to solve your problems. It can mean building a corporate culture that genuinely prioritizes the policyholder's experience, because the policyholder is the boss. This alignment is the secret sauce of the mutual model. When you file a claim, there isn't that inherent conflict of interest. Paying your legitimate claim isn't a loss for a shareholder. It's the company fulfilling its core promise to one of its own owners. This can lead to a claims experience that feels less adversarial and more supportive. The company succeeds when you are made whole after a loss, not when they find a reason to deny your claim. You might be thinking this sounds like a niche, small-town business model, but you would be wrong. Some of the largest and most recognizable names in the American insurance industry are mutual companies. State Farm, the largest auto insurer in the country for decades, is a mutual. Liberty Mutual, Nationwide, American Family, these are not small players. They are industry giants built on this very foundation of policyholder ownership. Millions of Americans are already members of mutual companies and may not even realize the unique structure of the company they're doing business with. Of course, no model is perfect, and it's important to look at the potential downsides. One criticism sometimes leveled at mutuals is that they can be slower to innovate. Without the pressure from Wall Street investors demanding constant growth and disruption, they can sometimes be more conservative, taking a slow and steady approach that might lag behind more nimble, tech-focused stock companies. Another consideration is how they raise capital. A stock company that needs a huge infusion of cash to expand or to cover massive losses can simply issue more stock. A mutual company doesn't have that option. They have to fund their growth and stability through their own operating profits or by taking on debt. This can limit how quickly they can grow or adapt to seismic shifts in the market. And it's worth repeating that dividends are never a sure thing. They depend entirely on the company's financial performance. In a bad year with lots of claims, or a year where their investments perform poorly, there will be no surplus to distribute. You shouldn't choose a mutual company solely on the hope of getting a dividend check every year. You should choose it based on the overall value proposition, competitive rates, excellent service, and the long-term stability that comes from a business model that is aligned with your own interests. Ultimately, the difference between a stock company and a mutual company is a difference in philosophy. It's the difference between being a customer and being a member owner. One relationship is purely transactional, the other is relational. With a stock company, you are buying a product. With a mutual company, you are joining a collective. You are pooling your resources with thousands or millions of other people to protect each other from financial loss. The company is merely the steward of that collective pool of money. This distinction is crucial. It changes the entire dynamic of the relationship you have with the company that protects one of your most valuable assets. You're not just a line item on a spreadsheet, a source of revenue to be maximized. You're part of the team. So we have the stock companies owned by Wall Street investors built for profit and speed. And we have the mutual companies, owned by Main Street policyholders, built for stability and service. These two models have dominated the insurance landscape for over a century. But they are not the only options. What happens when you try to blend these models? And what if there was an even more direct form of insurance? A structure that feels even more like a club than a company, where policyholders manage each other's risks almost directly. This next model is one of the oldest in America, yet many people have never even heard of it. And it might just be the purest form of insurance that exists. This model is called a reciprocal insurance exchange. And it's a fascinating structure that turns the entire concept of an insurance company on its head. Instead of buying a policy from a company, you are essentially joining a group of other people called subscribers to insure each other. Think of it less like a transaction and more like joining a financial co-op. You and thousands of others all agree to pool your money together to pay for each other's claims. You are simultaneously the insured and the insurer. Now you might be thinking, that sounds like chaos. Who manages all that money? Who processes the claims? Who decides on the rates? That's the brilliant part. The subscribers, as a group, don't run the day-to-day operations themselves. Instead, they hire a separate company to manage the exchange for them. This management company is called an attorney-in-fact. Let's break that down because it's the most important and often confusing part of a reciprocal exchange. The attorney-in-fact, or AIF, is a professional management firm. Its job is to do everything a normal insurance company does. It handles marketing, underwrites policies, processes claims, and invests the premium funds. But here's the critical difference. The attorney-in-fact does not own the insurance company. It doesn't own the pool of money. It is simply a paid manager. The subscribers, the policyholders, own the exchange and the money in it. The AIF is paid a fee from the premiums collected, but the rest of the money, the surplus, the profits, it all belongs to you, the policyholder. Compare this to the stock company we talked about earlier. In a stock company, your premium goes to the company, and after claims and expenses are paid, the profits go to outside shareholders. In a reciprocal exchange, your premium goes into a pool owned by you and the other subscribers. After claims and the AIF's management fee are paid, any leftover money, the profit, belongs to the subscribers. There are no external shareholders to satisfy. The entire structure is built around the policyholder's benefit, not an investor's portfolio. This is why some call it the purest form of insurance. It's a direct, formalized version of a community passing a hat around to help a neighbor whose barn burned down. The only difference is that it's done on a massive scale with a professional manager to make sure everything runs smoothly and legally. You've almost certainly heard of the biggest names in this space, even if you didn't know they were reciprocals. The most famous is USAA. That's right, the company consistently ranked at the top for customer service is a reciprocal insurance exchange. Its members, who are current and former military personnel and their families, are all insuring each other. Another giant is farmers insurance. While you see commercials for farmers, the entity you're actually being insured by is the Farmers Insurance Exchange, a reciprocal managed by its attorney-in-fact. Erie Insurance is another well-respected company that operates on this model. So what are the real-world advantages for you, the customer? The biggest one is the alignment of interests. In a stock company, there's an inherent tension. The company wants to charge you as much as possible and pay out as little as possible to maximize profits for shareholders. In a reciprocal, the goals are much more aligned. The subscribers want affordable, stable rates and excellent claim service. The attorney-in-fact wants to provide that because if it does a poor job, the subscriber's board of governors can, in theory, fire it and hire a different manager. The entire system is designed to serve the policyholder because the policyholder is the owner. This ownership stake can also translate into direct financial benefits. Because any surplus money belongs to the subscribers, it can be returned to them. This can happen in a few ways. Some reciprocals, like USAA, are famous for paying out annual dividends or distributions to their members when the company has a good year with fewer than expected claims. It's literally a refund of a portion of your premiums. Other reciprocals might use the surplus to lower rates for the following year, or to build up the company's financial strength, which benefits all members in the long run. You're not just a customer, you're a part owner, and you can share in the success of the enterprise. This member-owned focus often leads to a different corporate culture. Since they aren't relentlessly chasing quarterly profit targets to please Wall Street analysts, reciprocals can often take a longer-term view. This can foster a culture that prioritizes customer service and financial stability over aggressive growth. The legendary service of companies like USAA isn't an accident. It's a direct outcome of a business model that is structurally designed to put its members first. But as with everything, there are potential downsides and risks to consider. The historical and frankly scariest aspect of a reciprocal exchange is something called assessment. Remember how you and the other subscribers are all in it together? Well, what happens if there's a massive catastrophe? A series of huge hurricanes or wildfires, and the pool of premium money runs out. In a traditional, pure reciprocal model, the attorney-in-fact could come back to all the subscribers and assess them, requiring every member to pay an additional amount to cover the shortfall. It's the flip side of getting a dividend. If the group has a terrible year, you could be on the hook for more money. Now, before you panic and swear off these companies forever, it is absolutely critical to understand this. Today, virtually all major reciprocal exchanges that you would ever encounter, like Farmers or Erie, are non-assessable. This is a hugely important distinction. It means they have structured themselves and purchased their own insurance called reinsurance to make it so they can never legally assess their policyholders for more money. They maintain massive capital surpluses specifically to weather any storm. So, while the risk of assessment is part of the classic definition, for the modern consumer dealing with a major carrier, it's a non-issue. The risk is essentially zero, but it's important to know the history to understand the structure. A more practical disadvantage can be complexity. The whole attorney-in-fact and subscriber-owner relationship can be confusing. It's not as simple to understand as, I pay Geico, Geico pays my claim. This complexity can sometimes make governance a bit more opaque than a standard corporation. And while not being beholden to shareholders can be a good thing, some argue it can also lead to less pressure to innovate or be hyper-competitive on price, as they may prioritize stability over disruption. So, who is a reciprocal exchange best for? It's for the consumer who thinks of insurance as more than just a transaction. It's for someone who values being part of a member-owned organization and believes that a company that is aligned with its customers' interests will provide better service in the long run. If the idea of potentially receiving a dividend check back when the company does well appeals to you, and if you prioritize stability and a service-oriented culture over finding the absolute cheapest, bare-bones policy every 6 months, then a reciprocal exchange like USAA, Farmers, or Erie might be an absolutely perfect fit. It's a model built on trust and mutual interest, a throwback to a simpler idea of community, but scaled up for the modern world. We've now looked at models that are publicly traded, models that are owned by their policyholders like a private club, and models that are managed for their policyholders like a co-op. They all have roots going back decades, even centuries. But what happens when the business model itself isn't the innovation? What happens when Silicon Valley decides to completely reinvent insurance from the ground up, using algorithms, smartphone apps, and artificial intelligence to decide your rates, not just every year, but every single time you get behind the wheel? The answer might be in your pocket right now. That smartphone in your pocket isn't just for calls, texts, or scrolling through social media. It's a powerful sensor package. It has a GPS that tracks your every move, an accelerometer that knows how fast you speed up and slow down, and a gyroscope that can tell if you're taking corners too sharply. For decades, insurance companies have been trying to solve a fundamental problem. How do you truly know who is a good driver and who is a bad one? They use proxies: age, gender, credit score, zip code, marital status. All of these were just statistical guesses. They were trying to paint a portrait of you using blurry demographic data. But the smartphone gives them a live video feed directly from the driver's seat. This is the dawn of a new era, powered by a new type of company, the insurtech startup. Think of them as the Silicon Valley of the insurance world. They aren't bogged down by 100 years of legacy systems, brick-and-mortar offices, or an army of agents. They are built from the ground up on code, data, and a radically different philosophy. Their premise is simple, and it's incredibly seductive. What if your car insurance rate was based almost entirely on how you actually drive? This technology is called telematics, or usage-based insurance. And it's the engine driving these new companies. The most famous model is the one pioneered by companies like Root Insurance. Their approach is a complete reversal of the traditional process. You don't call them and get a quote in 15 minutes. Instead, you download their app, give it a whole lot of permissions, and then you just drive. For the next 2 to 4 weeks, that app becomes your silent co-pilot, your driving examiner. It's watching everything. It logs every trip, every hard break, every sharp turn, the time of day you drive, and how consistent you are. It's building a data profile of you as a driver, 1 mile at a time. Only after this test drive period is over will they give you a quote. Their entire marketing message is built on this idea of fairness and exclusivity. They claim they only insure good drivers. By weeding out the high-risk drivers from the very beginning, they can theoretically offer much lower rates to the people who make the cut. It's an appeal directly to our ego. Of course I'm a good driver. It's everyone else on the road who's the problem. So, if an insurance company wants to reward me for my superior skills, why wouldn't I sign up? It feels like you're joining a special club. A club where your good habits finally pay off. But that's just one flavor of the insurtech revolution. Another, equally disruptive model targets a different question. It's not just about how you drive, but how much you drive. This is the pay-per-mile model, championed by companies like Metromile, which has since been acquired by another major insurtech player, Lemonade. This idea exploded in popularity during the pandemic when millions of cars suddenly sat idle in driveways. People were looking at their insurance bills and asking a very logical question. Why am I paying the same premium to have my car sit here when I used to drive 50 miles a day? Pay-per-mile insurance answers that question directly. You pay a low flat base rate each month, say $40 or $50, that covers your car while it's parked. This is your comprehensive coverage. Then, for every mile you actually drive, you pay a few cents. Drive a lot one month, you pay more. Barely leave your neighborhood the next, and your bill plummets. It's a model that seems almost perfectly designed for the modern world of remote work, city living with great public transit, or for that classic car you only take out on sunny weekends. The risk is calculated dynamically. The less you're on the road, the lower the probability you'll get in an accident. It's simple, it's transparent, and for the right person it can lead to astronomical savings. So, on the surface, this all sounds like a massive win for the consumer, right? These insurtech companies promise a fairer, more personalized, and often cheaper product. They wrap it all in a slick, easy-to-use app that lets you manage your policy, file a claim by taking a few photos, and get help with the tap of a button. No more waiting on hold, no more faxing documents. It's insurance designed for the 21st century. And for many people, safe drivers who don't drive at 2 a.m. or low-mileage drivers, it absolutely can be a fantastic deal. They are finally being charged for their individual risk, not the risk of their 22-year-old neighbor with a lead foot. But there's a dark side to this data-driven paradise. A series of critical questions that you have to ask before you hand over the keys to your digital life. First, there's the black box problem. The app is tracking you, but the scoring algorithm is a complete mystery. It's proprietary. You slam on your brakes to avoid a deer that jumped into the road. A human would call that a smart, defensive move. The algorithm might just see it as hard braking and penalize your score. You drive home from a late shift at the hospital. The app doesn't know you're a doctor saving lives. It just knows that driving between midnight and 4 a.m. is statistically riskier, so your score takes a hit. You can end up modifying your driving behavior not to be safer, but to please an algorithm you don't understand. Then there is the massive, unavoidable issue of privacy. You are giving an insurance company a continuous stream of your location data. They know where you live, where you work, where you shop, what doctors you visit, how often you go to the gym or the bar. This is a treasure trove of personal information far beyond anything we've ever given an insurer before. These companies have robust privacy policies, of course. But in a world of data breaches and evolving technology, you have to ask yourself, is the potential for a lower insurance rate worth this unprecedented level of monitoring? And what about that seductive promise of only insuring good drivers? What happens if, after 3 weeks of letting Root or a similar company track your every move, their algorithm decides you're not a good driver? You don't just get a high quote. You often get no quote at all. You're simply denied coverage. You've just spent weeks generating data for them, all for nothing. The exclusivity that felt so appealing when you thought you'd be in the club suddenly feels discriminatory when you're left on the outside. Finally, there's the question of stability and service. These startups are fantastic at creating beautiful apps, but how are they at handling a catastrophic multi-car pileup with serious injuries? The legacy giants, for all their faults, have 100 years of experience in claims processing. They have massive cash reserves to handle large-scale disasters like hurricanes or wildfires. An insurtech company might offer a slicker claims process for a simple fender bender, but are they truly battle-tested? When things go horribly wrong, you don't want a cool app. You want a company with deep pockets and a proven track record of paying out massive, complex claims. This isn't just a new business model. It's a fundamental philosophical shift. We are moving away from the classic insurance principle of pooled risk, where large groups of similar people subsidize each other's losses, to a future of hyper-individualized risk. A future where every single action you take behind the wheel could have a real-time financial consequence. The promise is ultimate fairness. The peril is a world of constant surveillance where the scales are weighted by a secret algorithm. So, with these slick, data-driven startups on one side, and the old guard of insurance on the other, you'd think the choice is clear. You pick the past or you pick the future. But what if the giants are learning new tricks? What if the biggest names in insurance, the ones you see advertised during every football game, are now putting their own spies in your pocket? This is the new battleground. Not on billboards, not in clever commercials, but right here in the palm of your hand. The giants, the Progressives, the Allstates, the State Farms, they saw the nimble, tech-savvy upstarts like Metromile eating into their market, and they decided not just to compete, but to dominate. Their weapon of choice? Telematics. Usage-based insurance. The spy in your pocket. Goes by many names. DriveWise. Snapshot. Drive safe and save. But the premise is identical, a deceptively simple bargain offered to you, the customer. Let us watch you. Let us ride shotgun on every single trip you take. In exchange, we might give you a discount. It's a trade, your privacy for a potential premium reduction. So how does it work? How does this digital ghost get into your passenger seat? Most commonly, it's through the very device you're likely watching this on right now, your smartphone. You download your insurer's app, granted a dizzying number of permissions, and it silently goes to work. Using your phone's built-in GPS, it tracks where you go and how fast you get there. It uses the accelerometer to feel every time you hit the brakes, every time you accelerate, every time you take a corner. It even knows the time of day, punishing you for being a night owl or an early riser. Some of the most advanced versions even monitor for phone usage while the car is in motion, using the phone's own sensors to tattle on itself. The second method is a small device, a dongle, that you plug directly into your car's onboard diagnostics port, the OBD2 port. It's the same port your mechanic uses to figure out why your check engine light is on. Once plugged in, this little plastic box draws power from your car and transmits an even richer stream of data directly to the insurance company's servers. Speed, braking, mileage, G-forces in a turn, it's all logged, analyzed, and used to build a profile of you. Not the you on your application form, but the you that actually exists behind the wheel. On the surface, this sounds like the ultimate meritocracy. For decades, insurance has relied on proxies for risk. They used your age, your zip code, your credit score, your marital status, all crude demographic buckets to guess how likely you were to crash. It was a system that punished a perfectly safe 22-year-old driver in a city apartment while rewarding a reckless 50-year-old in the suburbs. Telematics promises to burn that old book. It says, "We don't care who you are. We only care how you drive." It's a seductive promise. The promise of fairness. The promise that your own good habits will finally be rewarded. And for some people, they are. If you are the textbook definition of a good driver in the eyes of an algorithm, you can see significant savings. Imagine a retiree who only drives a few miles a week to the grocery store in the middle of the day, on flat, straight suburban roads. They never speed, they accelerate like there's a carton of eggs on the dashboard, and they brake so gently the car seems to stop by suggestion alone. For this person, telematics is a windfall. Their data proves they are an extremely low risk, and their premium drops accordingly. The system works. But what happens when real life gets in the way? This is where the promise of fairness begins to crack. The algorithm isn't a wise, all-knowing driving instructor. It's a cold, unfeeling string of code. It's a judge with no concept of context. Let's talk about braking. The app flags hard braking events as a sign of aggressive, risky driving. But what if you slammed on the brakes to avoid a dog that darted into the street? What if a car in front of you stopped short for no reason? What if you live in a city like Boston or Chicago, where sudden stops aren't a sign of aggression, but a basic survival skill? The algorithm doesn't know, doesn't care. It just sees a spike in deceleration, marks a demerit in your file, and your safety score ticks down. You did the right thing, the safe thing, but you were punished for it. Let's talk about time of day. The data says that driving late at night is statistically riskier. There are more drunk drivers on the road, visibility is lower. So, the algorithm penalizes you for it. But what if you're a nurse finishing a 12-hour shift at the hospital? What if you're a baker heading to work at 3 a.m.? What if you're a parent driving home from your second job to provide for your family? You're responsible. Necessary driving is being lumped in with a kid leaving a bar at 2 a.m. You are being penalized for the circumstances of your life, not the quality of your driving. And the most insidious part? The discount itself. Is it truly a discount from a fair base rate? Or have the base rates been chow inflated, making these telematics programs less of a way to earn a reward and more of a way to avoid a penalty? Think about it. If everyone is encouraged to sign up, the pool of drivers who refuse to participate becomes, by definition, an unknown quantity. Insurers might view them as inherently riskier simply because they have no data. Their refusal to be monitored becomes a red flag, justifying a higher premium. The discount isn't a carrot, the lack of one is a stick. And in some states, it's not even a discount program anymore. Some companies have now made it clear that consistently poor driving, as judged by their app, can and will lead to a surcharge, an increase in your premium at renewal. The spy in your pocket now has the power to fine you. And then there is the great unanswered question. What happens to all this data? We are creating a permanent second-by-second record of our movements. Where we go, when we go there, how we drive to get there. The insurance companies swear up and down that the data is secure, that it's only used for calculating your rate. But we live in an age of data breaches. We live in an age where data is the world's most valuable commodity. Could this data be sold to marketers? Could it be used to deny a claim? Imagine you get into a minor fender bender. You claim the other driver cut you off. But your telematics data shows you were accelerating a little too quickly 2 seconds before the impact. Will your own insurance company use your data against you? And what about law enforcement? Could your driving data be subpoenaed in a court case? We are venturing into completely uncharted legal and ethical territory. We are trading a tangible asset, our privacy and our data, for the possibility of a small discount, governed by a secret algorithm we can't see and can't appeal. This is the Goliath's gambit. The big, national carriers have the brand recognition to get millions of people to download their apps. They have the massive budgets to analyze this fire hose of data and refine their algorithms. They are turning the very idea of insurance on its head. It's no longer about pooling the risk of a large group. It's about hyper-personalization. It's about creating a market of one. Just you, your car, and the unblinking eye of the algorithm that rides with you. They've taken the tech-first approach of the startups and scaled it to a terrifying new level. The question is no longer just about which company has the best rates or the best customer service. The question now is, what kind of relationship do you want to have with the company that protects you? Do you want a partner, or do you want a warden? Because as this technology becomes more and more common, the choice to opt out may eventually disappear altogether. The price for privacy may become a premium that most of us simply can't afford to pay. And that leaves us standing at a crossroads. Down one path is a world of perfect information, perfect pricing, and zero privacy. Down the other, well, what exactly is the alternative? The alternative is a return to the first principles of insurance itself. It's a path that re-embraces the idea not of individual risk, but of shared risk. It's a philosophy that sees insurance less as a personalized product you buy, and more as a community you join. A community that agrees, collectively, to bear the burden of the unlucky few. This isn't some nostalgic utopian dream. It's a fundamental structural difference that exists right now, hiding in plain sight within the insurance industry. It's the difference between a company owned by Wall Street investors and a company owned by, well, by you. Let's talk about mutual insurance companies. You've heard the names: State Farm, Nationwide, Liberty Mutual. These are giants, but they aren't structured like Geico or Progressive. Geico is owned by Berkshire Hathaway, a publicly traded company. Its primary legal duty is to maximize profit for its shareholders. Progressive is also a publicly traded stock company, answering to investors who demand quarterly growth. A mutual company, on the other hand, is owned by its policyholders. When you buy a policy from a true mutual insurer, you are not just a customer. You become a part owner of the company. There are no external shareholders. The board of directors is supposed to answer to you, the policyholder owner. Think of it like this: a stock insurance company is a global supermarket chain. It's efficient, has massive marketing budgets, and is laser-focused on generating profit for its distant investors. A mutual insurance company is more like a local food co-op. The members own the store, and the goal is to provide the best possible goods at the fairest price for those members. Any profit at the end of the year doesn't get shipped off to Wall Street. It gets reinvested in the store or given back to the members in the form of a dividend. That's exactly how mutual insurance companies can work. Because they don't have to satisfy the relentless demands of shareholders, their incentives are, in theory, perfectly aligned with yours. Their goal isn't to extract as much profit as possible from you. Their goal is to collect enough in premiums to pay out all the claims, cover their operating costs, and maintain a healthy financial cushion for future catastrophes. If they collect too much money in a given year, if claims are lower than expected, they can return that surplus to you, the owners, in the form of a dividend. For decades, this was a common practice. You'd get a check in the mail from your insurance company at the end of the year. It wasn't a refund. It was your share of the profits you helped create. It was a tangible reminder that you were part of a collective, not just a line item on a spreadsheet. This structure also gives mutual companies a different perspective on time. A publicly traded company lives and dies by the quarter. A CEO who misses an earnings estimate can see their stock price hammered overnight. This creates immense pressure to raise rates quickly, deny claims aggressively, and cut costs, even if it harms long-term customer relationships. Mutual companies don't have that pressure. They can afford to take a much longer view, prioritizing stability and policyholder satisfaction over short-term gains. This can lead to more stable pricing and a culture that's genuinely more focused on service. But let's be realistic. This isn't a perfect system. Many of the giant mutual companies today are so massive that the average policyholder feels just as disconnected as they would from a stock company. The CEO of a large mutual insurer still makes a multi-million-dollar salary, and you, as one of millions of owners, have virtually no say in how the company is run. And while the potential for dividends exists, many companies have stopped paying them out regularly, choosing instead to reinvest the surplus back into the business. Furthermore, because they can't just issue stock, it can be harder for them to raise huge amounts of capital quickly, which can sometimes slow down their ability to innovate or expand. So, the line between a big mutual and a big stock company can get blurry in practice. But the foundational difference remains. One exists to generate profit for investors. The other exists to provide insurance for its members. It's a choice between two different philosophies. And that's not the only alternative model. There's an even purer form of this collective ideal, known as a reciprocal insurance exchange. This might be the most fascinating and least understood structure in the industry. You know the biggest name in this space, USAA. Farmers Insurance is another. A reciprocal exchange isn't even technically a company. It's more like a formalized club. Here's how it works. The policyholders, who are called subscribers, all agree to insure one another. They are a group of individuals pooling their own money together to cover each other's losses. It's the most literal interpretation of shared risk. There is no company, there are only the members. Of course, a group of millions of people can't manage this on their own. So the members contract with a separate company, a management entity, to handle the day-to-day operations. This entity is called an attorney in fact. It collects the premiums, processes the claims, and handles all the administrative work, and in return it takes a fee. The key is that the pool of money for paying claims, the vast majority of the money, is owned by the subscribers themselves, not by a corporation. The attorney in fact manages the money, but it doesn't own it. This creates an incredibly powerful alignment of interests. The members want fair premiums and great service. The attorney in fact is motivated to provide that because if it doesn't, the members can, in theory, fire it and hire a new one. It's a model built on trust and a shared identity, which is why it has worked so brilliantly for an organization like USAA, which serves the military community. There's a built-in sense of affinity and mutual responsibility. So when we stand at that crossroads with the path of hyper-personalized, telematics-driven insurance on one side, we see now what's on the other. The other path is the one paved by mutuals and reciprocals. It's a path that says, your rate shouldn't just be about you, it should be about us. It acknowledges that the very nature of an accident is that it's unpredictable. The safest driver in the world can be hit by a drunk driver tomorrow. A person with a perfect record can have a tree fall on their car. The individual risk model says the person with the tree on their car should have paid a premium that perfectly reflected that infinitesimal risk. The shared risk model says that's nonsense. We can't predict the unpredictable. So instead, we all chip in a reasonable amount, and when lightning strikes, the community is there to help one of its own rebuild. This brings us to the most extreme version of the collective path: government-run auto insurance. In a few provinces in Canada, like British Columbia and Saskatchewan, the government is the sole provider of basic auto insurance. It's treated not as a commercial product, but as a public utility, like water or electricity. The goal is not profit, not even surplus for members, but simply to provide coverage at cost. The arguments for it are straightforward. By removing the profit motive, marketing expenses, and executive salaries, the system can be run far more cheaply, passing those savings directly to drivers. The arguments against it are just as predictable. Government monopolies can be inefficient, bureaucratic, and slow to adapt, and they eliminate consumer choice entirely. These three models, mutuals, reciprocals, and government insurers, represent the philosophical alternative to the stock market-driven, data-obsessed path that the industry is accelerating down. They remind us that there is another way to think about risk. But here's the unsettling truth. No matter which of these structures you choose, whether it's a stock company tracking your every move, a mutual company you technically own, or a reciprocal exchange you join, they are all being overwhelmed by the same external forces. The debate over corporate structure and data privacy is critically important, but it's happening inside a house whose foundations are cracking. There is a crisis unfolding in the background, a series of interconnected problems in our legal system, our healthcare system, and our auto repair industry that are creating a financial firestorm. This storm is pushing costs to astronomical levels, and it's threatening to make auto insurance unaffordable for everyone, regardless of how it's structured or how safely you drive. The choice between individual and shared risk may soon become irrelevant, because the cost of the risk itself is spiraling out of control. And in our final part, we are going to pull back the curtain on what is truly driving your rates into the stratosphere. It's a perfect storm, and you, the American driver, are caught right in the middle of it. The forces driving up your insurance premiums are not just one thing. They are a complex, interconnected web of technology, economics, and even human behavior. Let's start with the car you drive. Imagine a simple, low-speed fender bender. 10 years ago, this was a nuisance. A cracked bumper, maybe a broken taillight. A body shop would replace the plastic cover, pop in a new light, and you'd be out for a few hundred, maybe $1,000. The insurance claim was straightforward. Today, that same fender bender is a high-tech, high-cost catastrophe. That piece of plastic you call a bumper? It's not just plastic anymore. It's an advanced safety system. Behind that cover are ultrasonic parking sensors, radar units for blind spot monitoring, and cameras for cross-traffic alerts. A minor impact that barely leaves a scratch can damage these delicate electronics. And you can't just replace them. They have to be meticulously recalibrated. This isn't a job for a wrench and a screwdriver. It requires a clean, level space, specialized diagnostic computers, and a technician who has been trained to perform a procedure that can take hours and cost hundreds of dollars on its own. A single rear-end collision can require recalibrating systems on all four corners of the car. The cost skyrockets. And what about that broken headlight? It's not a $50 sealed beam unit anymore. It's a full LED or even a laser-powered, adaptive driving beam assembly. It swivels as you turn, adjusts its brightness automatically, and contains its own computer module. The cost to replace one of these headlight assemblies on a modern truck or luxury SUV can be $2,000, $3,000, even $4,000. For one headlight, this technological leap extends to every part of the vehicle. A cracked windshield used to be a simple replacement. Now that windshield has cameras and sensors embedded in it for lane keeping assist and automatic emergency braking. Replacing the glass means another expensive, complex recalibration is required. Even the paint is more expensive, with multi-stage pearl and metallic finishes being the norm. Add to this the lingering chaos of the global supply chain. That $1,000 headlight might be on backorder for 6 months. In the meantime, the insurance company is paying for your rental car. A rental that used to cost $30 a day now costs $60 or $70. 6 months of a rental car can add over $10,000 to the cost of a claim, all for a simple fender bender. The cost of labor has also exploded. The training and certification required for a technician to correctly repair these rolling supercomputers means they can command a much higher wage. So, the technology that makes your car safer is paradoxically making the financial consequences of an accident far more severe. And that severity is directly priced into your premium. But the vehicle is only half of the equation. The other half is the human body. Medical costs in the United States have been rising at a staggering rate for decades, far outpacing general inflation. Following an accident, what might have been a simple trip to the doctor for a whiplash diagnosis can now involve an MRI, multiple specialists, and a long course of physical therapy. The cost of a single night in a hospital, an ambulance ride, or a surgical procedure are numbers that can be difficult to comprehend. These costs are borne by insurance companies, and they are passed directly on to you. And this brings us to one of the most significant, yet least understood drivers of insurance costs: what the industry calls social inflation. This isn't about the price of goods or services. This is about the rising cost of lawsuits. All across the country, you see the billboards and the television ads. Injured in an accident? Call us now. This has fueled a dramatic increase in the number of lawsuits filed after accidents, and more importantly, a shocking increase in the size of the jury awards, known as nuclear verdicts. These are lawsuits that result in payouts of $10 million, $50 million, even hundreds of millions of dollars for a single accident. When a jury hands down a verdict of that magnitude, the money doesn't just appear out of thin air. It comes from the insurance company, and the insurance company doesn't just absorb that cost. To remain solvent, they must spread that massive unexpected loss across their entire book of business. That means everyone's rates go up. Your premium is higher today partly because of a verdict in a courtroom 1,000 miles away, in a case you've never even heard of. You are paying a hidden litigation tax every time you make your insurance payment. This trend has forced insurers to be far more conservative, holding vast amounts of capital in reserve just in case they get hit with one of these verdicts, which further drives up the base cost for everyone. Finally, there is a force that is bigger than any single car or any single lawsuit: the planet itself. The increasing frequency and severity of catastrophic weather events is wreaking havoc on the insurance industry. Think about it. A single hailstorm in Texas can damage tens of thousands of vehicles in a single afternoon, resulting in hundreds of millions of dollars in claims. A hurricane making landfall in Florida or Louisiana doesn't just damage homes. It floods and destroys thousands upon thousands of cars. Wildfires in California, floods in the Midwest. These are no longer once-in-a-generation events. They are happening with alarming regularity. These massive, concentrated losses are called catastrophic loss events, and they are fundamentally changing the math for insurance companies. An insurer can no longer just calculate the risk of you, an individual driver in Ohio, getting into an accident. They now have to factor in the increasing risk of a massive multi-billion-dollar weather event wiping out a huge portion of their insured vehicles in one fell swoop. This risk is national and the cost is shared nationally. So, a driver in Arizona might see their rates increase because of a hurricane in Florida. So what does this all mean for you? You, the consumer, are now armed with the complete picture. You understand that some companies like mutuals are owned by you while stock companies have to answer to Wall Street. You know that some insurers use your personal data to give you a better rate, while others rely on the old-fashioned, shared risk model. And now, you understand the colossal external forces that are squeezing every single one of these companies. The path forward is not to throw your hands up in despair. It is to act with knowledge. When you shop for insurance, you're not just looking for the lowest price. You're looking for a partner in managing risk. Ask the hard questions. How is this company rated for financial stability? Can they withstand the next catastrophic storm? What is their reputation for paying claims when things go wrong? The single greatest power you have is to control your own actions. Every time you get behind the wheel, you are making a choice. Avoiding distractions, obeying speed limits, and driving defensively are no longer just about safety. They are acts of financial self-preservation. In an era of skyrocketing repair costs, avoiding that one accident is the single most effective way to keep your costs down. And finally, recognize that the cost of your auto insurance is a reflection of our society as a whole. The safety technology in our cars, the cost of our healthcare, the behavior in our courtrooms, and the health of our planet, it all ends up on your insurance bill. Understanding this ecosystem doesn't just make you a smarter shopper, it makes you a more informed citizen. Auto insurance has evolved. It is no longer a simple product you buy once a year. It is a complex, dynamic, and deeply personal financial tool that sits at the intersection of technology, economics, and the unpredictable nature of life itself. Navigating it successfully requires more than just a driver's license. It requires knowledge. And now you have it.